Our thematic portfolio obviously starts as a pure equity portfolio. Now everybody knows and everybody is aware that equities can be volatile. They are driven by news flow, so even if the fundamentals don't change, changing news flow can lead to fluctuations in equities. We try to mitigate some of those fluctuations by focusing on those long-term structural changes, really make sure that what we are investing in remains relevant over the course of time and is able to decouple to some extent from those shorter-term cyclical fluctuations. However, it remains a pure equity portfolio, so for some investors this might be too much absolute risk, too much volatility, and this is where adding a credit portion to the portfolio, we are bringing down the overall volatility of the portfolio. You're still getting a good thematic exposure because the largest part of the portfolio is still the thematic equity portfolio, but at the same time we are able to mitigate even more the risk that comes with the equity investing. So you're keeping the upside, but at the same time we are trying to manage the downside for you.
There are two key benefits of adding Global Credit SRI and EM Corporate SRI strategies into Thematic Income Fund. First, it helps to generate potential income through a well-diversified portfolio of high-quality bonds. Second, it helps to reduce the overall portfolio volatilities. Within the allocation in credit sleeve of Allianz Thematic Income Fund, we have a static allocation with evenly split between Global Credit SRI and EM Corporate SRI strategies. With the other 50% allocation in EM Corporate SRI strategy, we are investing in emerging markets corporate bonds, both investment grade and high yield ratings. They provide income enhancement given a higher yield level. Also, they have shorter duration, which makes them less sensitive to interest rate movements. SRI stands for Sustainable and Responsible Investment. We believe a SRI approach will help to improve portfolio quality as well as to promote sustainable values. So how do we do that? This is a proprietary worst-in-class exclusion model. We aim to exclude the poor performance country and individual securities from a ESG, environmental, social, and governance perspective, as well as business behavior. We also have our firm-wide and controversial sector exclusions. We are restricted in investing into sectors like thermal coal, weapons, tobaccos, or sectors that are violating human rights. From there, we will form our eligible investment universe. And then we will carry out our standard credit process and conduct comprehensive credit research for our security selections. EM corporate credit yields have repriced to an attractive level after the macro reset in 2022. Looking at the JP Morgan corporate credit indices, the underlying yield have increased substantially from the lows being seen in 2020-2021, and they have almost doubled. Besides that, emerging market corporate yields always trade higher than the developed market counterparts, and that provide additional return. The level of yield pickup would vary over time, and we believe that at current level, it presents an attractive opportunity for investors to invest into this asset class. We think the credit fundamentals of global credits are solid. Global corporates entered 2023 with strong balance sheet as a result of robust earnings last year, as well as defensive business behavior. Looking at the key metrics of the corporate credits coming from the three regions, Europe, US, and emerging markets, they are all pointing at the right direction, with leverage declining and interest coverage rising. We believe the fundamentals of corporates will help them weather through the rising rate environment, and we believe that the positive trajectory will maintain in the near term. We think the credit fundamental of EM corporates are solid. Companies entering 2023 with strong balance sheets as a result of robust earnings in the last year, as well as defensive business behavior. The key credit metrics are pointing at the positive direction, with leverage declining and interest coverage rising. The strong credit fundamentals of EM corporates will help the company to weather through the rising rate environment. Moreover, EM corporates have demonstrated lower leverage compared to the developed market corporates consistently, which means they have a higher credit fundamentals in comparison under global context. Default is very rare with global investment-grade credits. Over the past 20 years, default rate has never risen over 0.5% in one single year, and with many other years, they are none. As a result, global investment-grade credit spreads have demonstrated a low volatility, and we believe that they provide reliable source of income. Many people would have an impression that EM corporate credits have high default rates, but in fact, it is not. The long-term average of EM corporate credits default is around 1.5%, which is comparable to the developed market peers.